We live? Hello everybody, Rick McBride here with McBride Mortgage Group, and I just wanted to let everyone know they get confused because everyone says, oh, the Fed lowered the rates yesterday. So if you don't know, the Federal Reserve lowered the interest rate that they lend bank to bank yesterday. And immediately, the mortgage rates shot up. Well, that doesn't make any sense, right? The Fed lowers their rate and the mortgage rate shoots up. How is that possible, right? Makes no sense. Well, what mortgage lenders want is certainty. And what they have now is uncertainty. So they were certain, I mean, you can never be absolute, but they were certain that the Fed was going to lower their rate. So what happens is, at this point, let's say, so first of all, what the federal rate is that's the amount that the banks lend money to other banks. So all of you that have done a closing before, you know you wire your funds, it goes to the Central Reserve, then it goes to the title company, right? Well, banks, every day they have to reconcile their accounts. So basically, and I'm not a banker by any means, this is the basics, the bare basics. But what they do is they lend money to each other all day long, and that's the rate that they lend the money at. So that rate that they're lending the money at was lowered a quarter point. So what happens is banks are in the business of what? Making money. So what they do is they take the Fed rate, and I'm going to use easy numbers. I know these aren't the exact numbers. But if the Fed rate is 4%, then they will lend that money to you at, say, 6%. Well, what happens is, in our society, we like to compete, right? So banks start competing for your business, which is why if you have an 800 score, you get a better credit report, a better interest rate than if you have a 600 credit score. You get a worse rate because you're a higher risk. But along with that, they compete. So uncertainty, so right now, say the last time they lowered the rates, it went up again. But with certainty, they'll go ahead and compete. But the day that the Fed lowers the rate, and not only did he lower the rate, he also said, yeah, we're not really sure about next month. So he created a bunch of uncertainty. So banks get nervous. So they immediately panic. And like everything else in life, as soon as you know something, you overreact, and then you figure it out, you figure it out, you figure it out. You're like, okay, this really wasn't as bad as I thought it was, right? So that's what the banks do as well. So let's say on this day, the rates are 4%, and they overreact. So they put their rate at 6.5%. Okay? Well, now they have a little bit of time to digest it. They went home, they slept on it, they get all their little spreadsheets out, the bean counters start working, and everyone starts working on it, and they're like, okay, so 6.5, so really, we could offer 6.25. Well, then what happens? What happens is, Bank 2 says, we're going to offer 6%. They're like, oh no, we're going to lose all our money. We're not going to have any loans. So they're like, okay, we're going to go to 5.75 and beat them. And then of course, then they go to 5.75. And at some point, you hit a baseline where they can't go any lower. But every time, you can go back and look, and every time that the Fed makes a move, the rates go up. So the chart kind of goes like this. If the interest rate chart, not to get too complicated or too inside baseball, but basically you're starting here, and rates kind of go down, go down, go down, go down, go down as they're competing. Then the Fed lowers the rate, and they're like, oh no, what's going to happen next? And so they go, we gotta overreact, and we gotta figure it out. Then they go down, they go down, they go down, and of course they go down a little bit more than there. And then in December, if the Fed were to say, raise the rates because the other problem the Fed has right now is the government's closed. So they're not getting any reports. They're having to do all this data off of independent sources and pickup sources and things that they don't usually have to work on. They have specific reports that they like to work from. They're not getting those now. So if they were to raise rates, I assure you the mortgage rate would shoot up here. If they were to lower rates, it's going to shoot up a little bit lower than this point. And then it's going to work its way down. So then it trends down. So it trends with the Fed rate, but it doesn't happen immediately. So that's why rates go up the second the Fed lowers their rate, almost like clockwork. Almost like clockwork. So if you're getting ready to lock your loan and you know a Fed rate decision is coming or a meeting, go ahead and lock it before it, because it's almost always probably, like my middle words, almost always probably going to go up. But we're not talking about a ton. I mean, we're talking about maybe 1/8 of a point. So really in payment, it's only $30, $40. But hey, we can save $30, $40 a month. We want to save $30, $40 a month, right? So if you're looking for a loan, if you're in the business, give me a call, 386, nope, not 386, 352-610-2680. Call me, shoot me a text. We guarantee you the best rate. If you already have a loan estimate from someone else, send it over. We'll beat it. But we give you the best rate, give you the best service. 352-610-2680. Been a pleasure.